On behalf of CrossCheck Media and Biz Talk Today TV, welcome everyone to the Money Path. I am your host Todd Schoenberger. Joining me today is Thomas Martin. He is a CFA and partner and senior portfolio manager at Globalt Investments located in Atlanta, Georgia. Thomas, we had a spectacular Q3. We started the quarter, I think there was a lot of anxiety because of the tariff situation, but going into today's trading, the S&P is up 7.6%. What is Global telling its investors to expect for the fourth quarter?
Well, probably more or less, more of the same. We expect a good fourth quarter. Whether it turns out to be as good as the third quarter or not, that's an open question. Because the third quarter, as you said, wasn't supposed to be that good. It's supposed to be a seasonally weak quarter, and September and October, and look out below, and then a rally in the fourth quarter. So maybe some of that was drawn in, but the news is still, good, really. The fundamental underpinnings of the market but behind earnings and interest rates and inflation and employment, are all reasonably good. The knock on the market is that it has gone up so much in a reasonably short period of time, and valuations, as everybody knows, are stretched.
Well, the justification for those valuations, though, I mean, clearly there's a lot of emphasis on the Mag 7 companies and with the continued narrative of AI being the positive, especially as we go into 2026 and beyond. But do you see any positives other than tech, though? Are there any other sectors or themes that you may be taking a look at now?
Well, one of the other themes that we've been investing in for a while now, and certainly in this year, is I'd call it the entertainment theme. People still want experiences. We know we got that coming out of COVID, and it's still been the case. So people are wanting to listen to music. So they're wanting to, keep their Spotify subscriptions up. They're wanting to go to live events. And so whether that's music or wrestling, things that are just, getting out and with other people. People have the money currently, and they're willing to spend it on those experiences. Cruise lines. People are wanting to go on cruises. Carnival just had a great quarter, and they're continuing to want to book out. So I think that that's an ongoing theme that is dependent on continued good employment and good kind of consumer vibes. But I think that's another area that we're overweight in.
We have had guests on talking about the labor picture and how that leisure and hospitality sector has actually seen job growth. So that does support your narrative there as far as the amount of demand that must be taking place to have to hire so many more people. With that, though, are you focused on when you talk about the cruise lines, is it hotels as well that you're thinking of?
No, we had been owners of the asset light hotel owners, so Marriott and Hilton, Hyatt, et cetera. We didn't own all of those, but we did own Marriott. Pick one of them, right? But they have been struggling, and so it's interesting that there's sort of weakness in the hotel area, but in the more specific area, like you said, in cruises, the demand has been very strong. So we've been out of the hotels and looking for an improvement in RevPAR, really, to see that comes back. The airlines would be another case where travel has been iffy, right? And at the low end, I think the consumer is suffering more. So there is that bifurcation that comes through in hotels and in the airlines, where the lower income cohort is struggling, and the upper echelons are really supporting that growth.
Let's talk about the Fed. So the Fed delivered what Wall Street wanted, was the 25 basis point cut, plus an indication that they may be cutting again in the final two meetings of this year. Do you feel that now there is a time to maybe rebalance the portfolio because of the new easing policy coming out of the Federal Reserve?
Well, I don't know that really. I feel sort of funny saying this, but I don't know that anything's really changed in terms of what you do with your portfolio with regard to the Fed. We have been telling our clients to remain diversified. And so you've had this move in interest rates off the bottom a few years ago, and then we sort of topped out on the 10-year and the 30-year in the 4.5 to 5% range, maybe a little bit above that. The market gets pretty scared when rates get to those levels, but we're well off those levels now. I don't know how much of that is as a result of the Fed easing. Part of the reason that the Fed has been easing is because inflation has been in check. It's not where they want it to be, but it's in a range that is somewhat comfortable. I think the issue has been employment, and we've gotten mixed numbers on that. And that's getting to be the scarier type of scenario is that, nobody wants a recession, particularly with the federal debt as high as it is and with the interest carrying cost as high as it is. If you stop getting revenues coming into the government or those decline, significantly, then you have a real problem for meeting the debt obligations. And that could actually put upward pressure on interest rates at the long end, even if inflation is coming down. So you have a lot of cross currents. And we think that, somewhere around a good old 60-40-ish mix is reasonable. We have less exposure to fixed income at this point, more exposure to equities, but we do want to have exposure to both.
What's your thoughts on the gold trade? Gold hitting at an all-time high today. Seems that there is that flight to safety right now. Is this something that should be considered for portfolios going forward?
Well, as I was saying that about our portfolio positioning, I was thinking about our gold position and was wondering if you might ask about it. So I'm glad you did. We have had a fairly healthy position in gold for several years now. And we also have a position in silver. So it's a significant part of the portfolio, and it really has help the performance of the portfolio. Obviously, since gold's been so strong this year, it's it's hard to say that now is a good time to initiate a brand new position if you don't already have gold. However, the underpinnings are really still the same in the sense that it is a non or a less correlated asset. It does well in times of uncertainty and let's not say extremes, but still when things are unsettled, whether it's an inflationary issue or really a deflationary issue. So gold is a flight to safety, although at this price, one has to ask if it's going to have a correction. But the underpinnings are there, and we have trimmed our gold position, and it's gone right back up. So, we're keeping an eye on it, but we're not going to be selling out of it or really doubling it anytime soon.
So I've had a number of guests on the shows on BTT, and they have told all of us that they have a specific ratio that they look at as far as the price of gold to the price of silver. Sometimes it's 40 to 1, 60 to 1, 80 to 1. What's your ratio that you're focused on? Because I think it's all over the place.
Right. Well, we don't have a specific ratio that we use to make our investment decision. That ratio was in general, attractive to us. And silver had lagged behind gold on a performance basis
Right.
until really the last couple of months. And so, these things are more technically driven. And so that ratio, it's a technical element, but it doesn't necessarily capture the zeitgeist of the market. And so now silver has really sprinted ahead. And so again, that has been somewhat corrected. But we're still maintaining our position there in silver.
And the final question for you, the budget concerns with the government, possible government shutdown. Is this a concern at all for Globalt clients or anyone else for that matter?
Well, I'm sure it's a concern for our clients, although we haven't really been getting, the phone ringing off the hook with regard to that. In fact, I had zero calls. But, it's always on people's minds and they wonder what's going to happen. I think if you've been around for even the last few of those, what you understand is that whoever decides they're going to shut down the government usually is the one that has to cave. Democrat or Republican, it doesn't matter, is that you can have all the rhetoric you want, but if you're the one who the people think is responsible for shutting down the government, you're the one that gets the blame. And usually that's the reason why it doesn't last very long. And there's some sort of a continuing resolution or way forward. So, no, we're not that concerned about the government shutdown. And we think that there are other factors that, make the market more attractive now.
Yeah, I believe you're right on that, and the government always seems to come through anyway at the very last minute. So I'm sure we'll see the same result. But Thomas, thank you so much for joining me today on the Money Path, and we definitely look forward to having you back on the BTT shows. Lots of insight today.
Great. Thanks so much for having me on your program.
Absolutely. So on behalf of Thomas Martin, I am Todd Schoenberger. Thank you once again for joining us on the Money Path. We'll catch you next time. Take care. That's great. We're out. Thank you so much, Thomas.
Awesome. Thanks, Todd. Thanks for having me on. Really, really always have fun.
Absolutely. I'll see you next time. Thank
Okay,
you.
so